this is part 2 of Demystifying the Digital Marketplace, and is really derived from all of the data you all have so graciously provided to Colibri Labs. We're joined by co-founder and CEO Cindy Estes-Green and Mark Lamano, partner and senior advisor. They're going to go through a lot of new and compelling data, and we will give you an opportunity to ask questions. Given the size of the group, your microphones are currently on mute, but for the Q&A portion, you can simply type in your Q&A throughout the presentation, and we'll get to those at the end and make sure that we address all of your questions and concerns and get your feedback. And just as a reminder, before I turn it over to Cindy and Mark, we will be providing you the full webinar for your perusal at your own leisure so that you can really dig into the data and share it with your teams. You should be getting a full recording of this presentation in the next 24 to 48 hours. And so with that, I will turn it over to Cindy and Mark, and thank you again.
Thank you, Rosanna. Thank you, everyone, for joining. We're going to share some of the highlights of the part 2 of Demystifying the Digital Marketplace. Most of the focus of part 2 is around hotel performance, so we have a lot of data to share. And then we're also showing some new data that we've created around the results of the Book Direct campaigns in the marketplace. Those findings will not be published in part 2, but we wanted to share it with this group within AHLA to give you some of our initial analysis points on that. So as many of you may be aware, and I'll run through this quickly so we don't spend a lot of time on it, the book Demystifying the Digital Marketplace is a follow-on from a study Mark and I had written in 2012 called Distribution Channel Analysis. We now have a database that's a resource for the industry that takes data from over 25,000 hotels. We look at a transaction level, so we have every guest stay going back to January of 2011. The analysis that we're going to share with you today, however, is largely from June of 2014 to June of 2016. So we have 3-year history showing the data during that period, and we'll share as well some information at a chain scale level as well as at a national level. In addition, we have Airbnb, supply and demand, consumer review, data for every hotel, loyalty program data, and we've integrated this. And in our highlights today, we're not going to get into everything, but the part 2 of the book will be released in the next couple of weeks, and there's lots of detail that you'll be able to get into at that point. Part 3 will come out later in the spring, and that really gets into using this data and showing different analytical models that will be possible, things like lifetime value analysis, flow-through analysis, ancillary spend analysis, different ways that your teams can use this data or use these models to kind of look at your own business. So the first thing I'll do just from a definitional point of view is as we did the analysis on the data, we looked at revenue, but revenue comes in many forms. So we have the traditional revenue that everybody thinks of as P&L data, which is hotel collected revenue. We actually add the wholesaler commissions on top of that because there's a fair amount of revenue that's paid to third parties like wholesalers, opaque, and merchant model OTAs that is paid directly to the third party, so it is never posted onto the books of a hotel. When we add that third party wholesaler commissions, we get the total of what the guests actually paid, whether they paid it to the third party or to the hotel, and we call that guest paid revenue. We then take that guest paid revenue and we remove each of the primary component costs when it comes to acquisition costs, and those costs that are directly associated with the transaction are things like wholesaler and retail commissions, loyalty, investment, channel costs, transaction fees. So all of those costs, when they're removed, are the costs that are triggered when a transaction is consummated. And the revenue that we're left with is called COPE revenue. And COPE is an acronym that we use. It's contribution to operating profit and expense. And that is a form of net revenue with just the direct costs removed from it. We then take one final step and we remove all of the sales and marketing expenses, which are not directly related to a transaction, but it would be things like payroll and things like media costs, social media costs, things that are not transaction specific. And once those are removed, we end up with what we call net revenue. So as we do this analysis, this is the terminology that we'll use, and we wanted to make clear what each of those types of revenue actually represents. And I will turn over to Mark to do a few more.
Thanks, Cindy. As Cindy just explained, there's the 4 revenue categories: guest paid revenue, hotel collected revenue, COPE revenue, and net revenue. What you're seeing now is a chart that shows the revenue growth in each of those categories for the 12 months ending in June of 2016, with the guests paying a relatively healthy 4.6% more in purchasing the room. But at each step along the process in terms of paying the acquisition costs, the hotels are slightly less efficient, so that by the time you get down to the net revenue number, that even though the guests paid 4.6% in incremental revenue, the industry only had 4% left to apply to operations and all the things you need to do to run a hotel. If you take that number and look at it from a national perspective, you can see that this is a complicated chart, and I apologize a little bit for that. But if you look at this, the guest paid revenue for the 12 months ending in June of 2016 was about $146.9 billion. And as you travel down in the dark blue line, each of the various steps to hotel collected revenue, to COPE revenue, to net revenue, you end up with a net revenue of $123.3 billion, which means that the industry as a whole paid about $23.6 billion in 2016 to get the customer in the door. Cindy alluded to the fact that some of that guest paid revenue never shows up on a P&L. In that time period, that number was about $3.5 billion. If you look to the bottom of the chart, you'll see circled a category that we call revenue capture, which is simply the percentage of revenue that the industry had left over after they paid to acquire the customer. So in the 12 months ending in June, that number was 83.9%, as compared to 84.4% in the 12 months prior. That calculation is simply the net revenue number as a percentage of the guest paid revenue number. So if you look at that, you see that, again, there's a slight decline over the last 12 months. And 0.5% doesn't seem like all that much. However, when you apply that to the nation as a whole, and you basically conclude that the industry is slightly less efficient, if the industry had performed in the 12 months ending in 2016 as they had in the prior year, meaning the same percentage of their revenue went to acquire the customer. If you look back to the top of the chart, that would have meant that the industry had $729 million more in profit, because that was just a shifting of expense to one channel to another. And if you're an owner, and just to pick a number, you want to apply an 8% capitalization rate on that, that implies that the industry lost about $9 billion in asset value over the time period. So you can see that as that revenue capture number declines, not only does it have an effect on the operating performance of the hotel, but it also has an effect on the asset value of the hotel. As we mentioned earlier, when you look at hotel collected revenue versus guest paid revenue, there's a little bit of a discrepancy. We estimate that over that most recent 12-month period, that discrepancy was about $3 a room night. So instead of the $120 that tends to be reported for the time period, the ADR that the guest paid was actually $3 higher at $123. In some markets, it was even larger than that. So this chart presents to you, basically that number, the guest paid revenue in 2016, and from it, it subtracts the 2 major transactional parts of acquiring the guest. The non-P&L transaction costs, which Cindy talked about in the beginning, were our commissions and fees that the vendor keeps before they send the ADR numbers back to the hotel, which is in the red, and then in the green is the P&L transaction costs that are more retail commission costs that come off the P&L. Now, as you can see, the customers over the 2-year period from 2014 to 2016 paid 8.4% increase in guest paid revenue, okay? But by the time you actually got down to the COPE ADR, the blue all the way to the left-hand side, you see that that was only 7.8%, meaning that the associated transaction costs, both P&L related and non-P&L related, grew at a slightly faster rate. Now, thinking about how customers book rooms, this pie chart shows you 2016 demand share for the various booking channels. What's highlighted are what we call the online booking channels, which is brand.com, GDS, and OTA, which represented about 42% of all room night bookings in 2016. Now that number is up from 35% just 2 years prior in 2014, which means there's a significant shift overall in the number of rooms that are booked online as opposed to some traditional channels. On the next chart, you're looking at, if you look at the OTA channel, kind of how the bookings are going through the 3 major OTA agency models. The opaque, which is the top at the red, retail, which is in the yellow, and net or merchant, which is in the orange. Now, surprisingly, each of these 3 have been growing in each year. You know, we were a little surprised that the retail component, while growing substantially at over 100% over the 2-year period, is still a much smaller share than the traditional net merchant model, which we assumed would show a little bit more of a decline, or a decline in general instead of continuing to grow. So all 3 of the channels are still utilized, with the opaque channels showing the only one that's showing a slight decline. And, you know, again, was a little bit surprising to us. If you now look at the share of bookings by channel for the 3-year period, 2014, 2016, you get a feel for kind of how the consumers are booking rooms a little bit differently. The 3 sets of bars to the left, brand.com, voice, and property direct, are direct channels to the hotel. The orange bars, kind of in the middle to the right, OTA, GDS, and FIT wholesale are what we call indirect channels. And over to the right is group, which is a combination of the 2. One note about the group number, around 14%, is that depending on what segment you're in, that group number can be substantially different. Most numbers that people have published about the percentage of group business prior to this tended to be in the 30% range, but that was because most of that information was based on group-heavy segments, luxury, upper upscale. Now, oversimplifying it a little bit, what you notice is that there's a large decline in property direct from 39.4% to 34.3% over the 2-year period, and that's a substantial decline. If you look at that and you calculated that number and kind of how many rooms, how many people are shifting their booking patterns, that equates to about 140,000 bookings a night that are moving from property to direct to another channel. And again, oversimplified, the majority of that movement is either to brand.com, which grew 9.1% over the period, or to OTAs, which grew at 28%. Now, earlier on in the previous slide, I talked about the 3 indirect channels versus the direct channels. So this slide shows the percentage of rooms that are booked from a direct channel versus an indirect channel, and it is just the transient demand. So group is not included in this chart. So 2 years ago, for every room that was booked through one of the indirect channels, again, OTA, GDS, or FIT wholesale, 3.3 were booked directly to the hotel. In just 2 years, there's been an 18% decline in that, so that now for every room that's booked indirectly, 2.7 are booked directly to the hotel, which means as consumers are more and more turning toward some of those indirect channels as they shift, again, away from property direct. When you look at it from a cost standpoint, this chart indexes 5 categories. The one that's the gray one, which is maybe the hardest to see, guest paid revenue, is growing at about 15% from where it was in 2014. And then there's the associated costs, channel costs, retail commissions, and loyalty investment, all growing at, at or about the same rate as revenue. But then there you see OTA commissions growing at about approximately, 40% or indexed it to 140, however you want to look at that, which the real point here is that it's growing substantially faster. So even though many of the major brands and companies have negotiated lower fees through those commission channels, the only way the math could work on this chart is that more rooms are being booked through the channel. So even though the fees are a little bit lower, with the more rooms being booked, it ends up being an incremental cost. Now, the next chart shows the relative costs of each of the channels. And again, this is a little bit of a complicated chart, but if you look at property direct, which is the third bar from the left, you'll notice that we've indexed that as 100 because that's the most cost-effective channel for a guest to book a room to a hotel if you look at it exclusively from a cost perspective. And you can see the three categories to the left, the direct channels, tend to be much more cost-effective channels than the indirect channels. And the way to kind of look at this chart is to look at, let's say, brand.com is costs about 2.6 times to have a guest book through brand.com as to come to the property direct. But if you look, for example, at OTA, that's about almost over 6 times as much in terms of the actual cost to a property. And that's kind of how you look at that chart. So it makes some sense that as guests, again, ship out of that property direct channel, it's very important to understand where they're going, how they're getting there, and trying to shift them to a less cost-invasive channel. The next chart shows the percentage of loyalty contribution to the percentage of total bookings through each of the chain scale categories. And you can see, depending on what chain scale category you're in, it is a substantially different level of loyalty contribution. A lot of the brands and companies and independent hotels are now trying very hard to increase, the number of loyalty customers, and you can see some of them have been very effective. All have been effective in increasing the percentage of loyalty customers that book, and some segments, particularly the middle categories, upper mid-scale, upscale, and upscale, have bookings, over half of their bookings to the hotel are from loyalty members. So going forward, there's going to be a real push, as everybody knows, to having as many bookings come through those loyalty channels. And now I'm going to turn it back over to Cindy.
So moving to some of the different hotel segments for a moment, and just looking at comparisons, we group the hotel segments into upper tier, which is luxury, upper upscale, and upscale, middle tier, which is upper midscale, and the lower tier, which is midscale and economy. And what we wanted to look at was RevPAR, but as we said right from the beginning, we have the guest paid revenue-based numbers, which is based on what the guest really paid, whether they paid it to the hotel or to a third party. We have the hotel collected number, RevPAR, which is the more traditional RevPAR, and the COPE RevPAR, which is the amount after we've taken the direct cost out of it. So if we look, just to point out a few things here, the lower tier actually had the fastest growing guest paid revenue, which was terrific. They grew 4.1%. The downside of that, however, is that the COPE RevPAR was only 3.1%. So if the economy and mid-scale hotels could keep their revenue at the same rate that the guests were paying more, and the hotel could keep the same amount that the guests were paying more, then the COPE RevPAR would be 4.1% growth also. But we weren't able to keep it because there was a lot of inefficiency, and there were a lot of faster growing acquisition costs that grew faster than the guest paid revenue did. And therefore, the COPE RevPAR only grew 3.1%. In contrast, the upper tier is much flatter. So even though the guest paid revenue didn't grow as much, they actually kept almost as much, the amount they kept grew almost as fast as the guest paid revenue grew. And then the middle tier is kind of in the middle. They had quite respectable 3.6% growth in guest paid RevPAR, and the COPE RevPAR grew 3.2%, so it was sort of in the middle there as far as the amount they were able to keep. So just in looking at the chart that Mark had shown earlier, in terms of the number of direct bookings for every indirect booking, the lower tier had many more bookings, started at a much higher place with almost 6 direct bookings for every one that came indirectly, and a lot of that is driven by the property direct, the drive up and walk-in business. They actually had the steepest decline because they've actually dropped 33% down to 4 direct bookings for everyone indirectly. And there's flatter lines for the middle tier, and the upper tier is actually a relatively flatter line as well. So all of this, a lot at the lower chain scales, is really driven by the property direct is moving straight to the OTA segment. That's what we notice happening. So for the upper mid-scale, and economy, their drop in efficiency and their drop in COPE RevPAR is all tied to a very strong shift from what used to come in directly to the property is now being booked largely through OTA. And again, on the upper tier, the reason that they had the best revenue capture performance is because there was actually a notable drop in opaque OTA and a notable gain in brand.com, the largest increase actually in brand.com. And that combination made for quite efficient results for them. Even though the guest paid revenue didn't grow as much, they kept more in general. So just summarizing, guest paid revenue grew at a healthy clip, 4.6%. However, even though net revenue is rising, it's not rising as quickly, only 4%. Overall, hotels are paying 16 to 18% to get their customers, but many thousands of hotels paying 25 to 35%. OTA commissions are rising about 3 times the rate of guest paid revenue. The OTA channel is still substantially lower as a percentage of total U.S. room nights compared to brand.com. OTA at 12.4%, brand.com still at 20%, almost double. However, OTA is growing at a faster rate. The loyalty contribution is 40 to 60% for most of the market and growing. And it's proven to be a potent force in the market. Brand.com has a lot of strength in the last year because of that. And then another point, meta search is really gaining on the legacy OTAs, and what's happening is the meta search model, which is generally auction and bid-based, is forcing the OTAs and brands to bid against each other, forcing the smaller chains and independents out of the picture and driving costs up for everybody. So I'm going to just very quickly take a few minutes and give you some highlights of the analysis we've done on the Book Direct campaigns. So one of the analyses we did was to look at the difference in the average rates coming through brand.com versus the average rates coming through OTA, all on a net basis. So what we wanted to do was see all of the loyalty guests loyalty only coming through brand.com and look at that differential. And of course, that loyalty guest is much more than just the Book Direct users. There are lots of other customers. As you can see, we separated out the corporate negotiated as a percentage. There's still a very strong premium in the average rates coming through brand.com by loyalty guests. Upper upscale, the premium is 20.2%, down to upper midscale at 12.6%. So we did a deeper dive on this, and we actually isolated just the loyalty members who were buying the Book Direct member price, the discounted rate, as everybody talked about, to see what the differential was between that average rate, again on a net basis, and the average rate of the OTA after we removed all commissions and transaction fees. And again, we have a positive differential premium, and we have luxury in this analysis, 18.6% premium down to upper midscale at 3.4% premium. So some might say that there's still, some guests took the discount who might have paid full price and the differential would have been higher, but a lot of the OTAs have claimed that there's, on a net basis, the OTA rate is actually more beneficial to a hotel, and the numbers just don't bear that out. So we did another analysis to look at how the demand has changed on a room night basis, and I'll draw your attention to the red bar that you're looking at. So we're looking at total U.S., and that red bar represents the total U.S. The blue, green, and yellow represents Chicago, Dallas, and New York. So what we did was we wanted to know for the growth in the market for the transient, this is just transient room nights, for the total transient room nights year over year, what is the how much of that growth was driven by brand.com, what portion was attributed to OTA, what portion to GDS, just looking at how much of that transient business was driven by the 3 online channels. And of the 2% total transient growth for the U.S. market, 2.6%, over 2 of those points are due to brand.com growth, and OTA and GDS is substantially lower, kind of 0.5 or less. Again, what we're looking at is upper upscale only, and this is data for January through December 2016 compared to the same period, same calendar year of 2015. So we haven't seen a growth in brand.com or haven't seen brand.com drive the growth as strongly as we see it for this year. So there's no question that the Book Direct campaigns had to be a factor in this for brand.com to be so substantially higher. So we have the same data for upscale, which is not quite as strong. There was 4.6% growth overall, and about 2.5 points of that is brand.com, with the balance being OTA and GDS. And then if we look at the upper mid-scale, just in contrast, same general picture, 3.3% growth, and again, about 2.5 points of that through brand.com. So there's no question that brand.com was got a substantial boost over the last year because of those campaigns. And we see that the rates were still reasonable given the fact that there was some discounting involved in that initial entry into the market. So we did one more kind of analysis. We wanted to actually do a linear regression to be able to look at the patterns of brand.com and OTA over the last couple of years to see what the pattern looks like in terms of growth and what we would have expected versus what actually happened. The dotted line that you see shows what was expected based on the linear regression model, and you'll see both for brand.com, what was expected was lower than what happened, the actual was higher, and for OTA, what was expected would have been higher OTA, and it was lower, with the exception of the month of July, which, not surprising, OTA business was very strong. So all in all, there's no question that there was an impact in the market. And the last point that I'll make is related to this trade down, as some have said, what did it really cost with the combination of the discount and all the other factors? And what I would suggest is that there's a weighting that one has to look at. On one hand, and I'll show this visual, on one hand we have the discounts and the trade downs. On the other hand, we have the value of added loyalty membership. And when we ran trade down analysis for about 12,000 hotels, we looked at them individually and ran a trade down model to see exactly what it cost them or what they gained from participation in the Book Direct programs. And it was a bell curve, which I won't go into more detail on this now. There were some hotels that really had bigger losses, and there were some hotels that actually had substantial gains, and the majority of the hotels were in the middle. The average trade down cost to a property between upper mid-scale and upper upscale, and we did it by chain scale in addition to individual hotel, was about $17,000 to $35,000 for the period of May through December. And then we looked at the loyalty programs, thinking what is the value of one new loyalty member, and we ran some averages on typical number of stays, typical average length of stay, typical average rate, thinking, if you paid more for the first visit, but you knew you were going to get this guest to come back 2 times or 3 times, paying whatever amount they might pay, assuming they wouldn't be coming through a third party, where is the break even? And, on average, the $17,000 to $35,000 cost actually would equate to about somewhere between 35 and 70 new loyalty members to sort of break-even point, above which the hotel ends up with greater benefit over time. In addition, besides just the transactional comparison, the loyalty guests, you'll have the opportunity to give them better customer service. You know more about them. You can interact more with them, even post-stay, pre-stay, diversifying sources of business so a hotel doesn't get too dependent on one channel or another. and better control in down cycles when you really need to make sure that you're not so dependent on one channel that in a down period you'll be having to pay extreme amounts for commissions and not even be sure you'll get your business. So we are going to publish a paper on the Book Direct campaigns with much more detail than this. I just wanted to give kind of a high-level view to show that we've looked at it many different ways. And just to sum up, part 3 of the Demystifying series, Taking Action, will come out later in the spring, and that'll start giving a lot more of these analytics and different kind of cost models, helping a hotel find what their optimal business mix is and figuring out different analytics ways to use the data to get there. This part 2 of the book will be released in the next week or two, and AHNLA will notify everyone, and I'll stop now and see if there's any questions. Thank you very much.
Thanks, Cindy. Thanks, Mark. Really appreciate it. Just a reminder to folks, if you do have a question, you could go to the bottom right-hand side of your screen where it says Q&A and type in a question. Cindy, we do have one question for you and Mark right off the bat. How do you see loyalty programs affecting customer booking behavior? I know you touched upon that in the last few slides, but if you want to address that.
Yeah, so there's no question that these Book Direct campaigns have moved the needle as far as changing consumer behavior. I think there's more channel agnostic consumers, not all of them are, but there's a large group of channel agnostic consumers who will be moved. The question is, you know, the first entry in the market were discount related, and I don't think anyone wants to turn brand.com into a discount channel. So I think that anything that will offer the consumer the convenience and advantages, whether it's service-related advantages or something else, will attract their attention, and they'll be willing to do something if there's something in it for them. And we absolutely see a shift as a result of the Book Direct campaigns that were in the market. But I'll say it's not uniformly, equally, exactly the same in every property. There were properties that did not benefit from the programs, and there were many, many properties who benefited greatly, and then there were a whole bunch that were sort of neutral. So yes, the good news is that we were able to see evidence that the brands were able to move the needle and get consumers to change their behavior. But, you know, obviously we'll have to see more in the future what kind of differentiators and conveniences are being offered to continue that pattern.
And one more question for you from the group. In your study, do you put hotel collect bookings into a retail bucket, even if it was a discounted rate provided to the OTA?
We don't, the hotel collect is going to be, it's going to be tracked as a retail booking, yes, because the hotel pays and then the hotel writes a check, so that's a traditional retail travel agent arrangement. So whether or not the rate was discounted or not, it's still a retail booking. The way that we'll capture the discount is because it's going to show up in the rate. So we're going to see, we know how much the commission is, so when we net the rates down, we remove those commissions and we'll see what's left. If a higher percentage of them are discounted, then the rate's going to be lower. The net rate, the COPE rate is going to be lower. Hopefully that answers the question.
Thanks, Cindy. Doesn't look like we have any other questions at this time. Given the time, I think we will wrap this up. So want to thank both Cindy and Mark for their thoughtful analysis. And again, just a reminder to everyone on the call, we will be sending the full recording to you in the next day or so that you have it and can go through it. And again, if you have any questions after you digest the material, I'm sure Cindy and Mark will make themselves available, and we're happy to facilitate that as well. I want to thank you again for your patience with our technical difficulties, and thank you all for joining us. Thanks, Cindy. Thank you, Mark.
Thank you.
Thank you.